Good morning and welcome to the new episode of Dr.Lamba's Awakening Call. We people are happy that the lockdowns are practically coming to an end and possibility of economy reviving should be there. But are we really myopic? I may not refer to the normal average citizen, but the economists and the policymakers when they keep their eyes shut, when they bury their heads in the sand like an ostrich, there is a cause of alarm. The conditions today, especially the economic ones, are ripe for a repeat of 1970s stagflation and also of 2008 debt crisis. Are we going to have stagflation again? Now, what is stagflation? It's a recession inflation, and it's a very dicey situation in which the inflation rate is high, the economic growth rate slows, the unemployment remains steadily high, and it presents a dilemma for the economic policymakers since actions intended to lower inflation increase unemployment. And as I said, the conditions today are absolutely ripe for this eventuality to take place. And it happens all the time when we are least expecting it. It's characterized by a slow economic growth, relatively high unemployment or economic stagnation, and that is accompanied by inflation. Now, this is a paradox. Normally, when the inflation is there, the it means that more production is there, more supply is there, and people are having more money to spend. But stagflation can alternately be a period of inflation combined with a decline in GDP. And we have seen the GDP of all the countries slowly and steadily declining. The warning signs are there for the global economy, and the central banks would be left in no position to encounter it. It would be an impossible position. As a matter of fact, today's extremely loose monetary and fiscal policies being adopted by most of the countries, especially liberal countries, when combined with a number of shocks, could result in 1970s style stagflation. In fact, the risk today is bigger than it ever was because of the great stimulus money and the funds being provided by the government, which makes the people not work. Have you seen how many people are resigning their jobs and adding to the number of the unemployed and becoming unemployable? After all, debt ratios in advanced economies and most emerging markets were much lower in the 70s than they are today. And because the debt ratios are low, stagflation has not been associated with a debt crisis. If anything, expected inflation in the 70s, that it would wipe out the real value of the nominal debts at the fixed rates, thus reducing many of the advanced countries' public debt burdens. If that was to be so, then countries like Canada, countries like USA would not be having trillions of dollars of public debt. Conversely, during the period of 2007 2008, and that's not very old, financial crisis was there, high debt ratios are there, and those high debt ratios were both for the public debt and the private individual debt, household debts. It was a real debt crisis, and the housing bubbles burst Result, ensuing recession led to low inflation, but not deflation. And owing to the credit punch, there was a macro shock to aggravate demands. Risks today are on the supply side. That's the difference. Till now, the emphasis has been, or the culprit has been the demand side. Now it is the supply side. And this creates a curious conundrum. And I'm amazed that not a single finance minister, except German Chancellor and the Chancellor of Exchequer, England, these two are the only policymakers who have visualized and discussed the worst of the stagflation of the 70s and the economy breakdown of 27 to 2010. Today, debt ratios are much higher than they were in the 70s. And as I said, the mix of loose economic policies and negative supply shocks would fuel inflation. In Canada, for example, the food prices in 1 year have gone up by 23%. And the likelihood is that because of the drought in USA and the Northwest America, the prices are further likely to go down by 13 to 15%. And if there's a next wave of corona, then it might cross 50%. Today, the people depending on the food banks has increased by 36%. So and then the economic policies are just depending on giving the stimulus funds, not on increasing employment, they're decreasing employment. And those loose policies are feeding the acid bubbles that will continue to drive the consumer price inflation. The warning signs are already apparent today, but then only the few people always look to the warning signs, they ignore them. And that's what's happening. The price to earning ratios are very high now. Have you ever seen that? That your earning compared to the prices, the ratio is much too high. Normally, the PPP, the purchasing power parity, should be maintained. This parity has disappeared. The irrational exuberance surrounding the special purposes acquisition companies, then the crypto sector, currency, people are going in for bitcoins and irrational actions over there, high yield corporate debts, the collateral loan obligations, private equity, startups, meme stocks, runaway retail, day trading. Normally, the trading used to be through the financial people, and now the computer and the internet. About 35 to 40% people are instant traders. So speculation is increasing. So the result would be at one point the bubble will burst. And this boom, which we are seeing in the economy, so-called stock market, it will culminate in a Minsky moment. Now, what's a Minsky moment? Minsky moment is a sudden loss of confidence. And the tighter monetary policies will then come into being, trigger a bust, and crash. The economy will be doomed. In the meantime, what will happen is that the loose policies that are feeding the bubble will continue to drive price inflation. You keep on giving money to the people without anything. They resign their jobs, become drones, and then they keep on spending money not on essentials but on luxuries and comforts. So it creates conditions for the stagflation whenever the negative supply shocks appear. And such shocks followed from renewed protectionism. You have seen that already in the pulses fight between Canada and USA. It was protectionism, nothing else. Now the dairy industry, NAFTA issues, all that. Now demographic aging is another factor. In advanced countries and emerging economies, the ageism is taking place. Older and older people are living. The younger people are less in number. Then the immigration restrictions are going to be enforced still further. Some countries like Canada and might be very open, but countries in Europe, they are very, very going to be very strict. Australia is going to be very strict. So what will happen? The reshoring of the manufacturing to the high cost regions or balkanization of the global supply chain. And once the global supply chain is snapped, then it's an terror. Then comes the Chinese American decoupling. That will fragment the global economy at a time when supposedly climate change and COVID are pushing the national governments towards deeper self reliance. So, even if protectionism is not there, to save themselves, the government would have to concentrate on self reliance. That's what Modi talked about, Atmanirbhar. And once you are in the process of self reliance, it's a good thing. But it is harmful for the global economy because the global economy is knit like a sweater. You take a skein of a wool out, the whole sweater is gone. And that's what's going to happen. Then the impact of the cyber attacks on the critical infrastructure, the social and the political backlash against inequality. This revolution, the woke revolution, what they call it, they are basically recipes for microeconomics disruption. Then, what makes the matter worse is the role of the central banks. Central banks the world over, whether it's a federal system in USA or whether the Reserve Bank in India or whether the Bank of Canada, the central banks have lost their independence. Today, they have little choice but to monetize massive physical deficits to forestall a debt crisis. So their whole role is politicalized. Instead of economy and economic reasons dictating their decisions, is the political decisions. And with the both public and the private debt soaring, the banks are going to face a debt trap as inflation rises and will keep on rising. There's going to be a dilemma that will face the central banks. If they start pushing out the unconventional policies and raise policy rates to fight inflation, they will risk triggering a debt crisis and risk a recession. If they maintain a loose monetary policy, they will risk double digit inflation and deep stagflation. And that would happen when the next negative supply shocks emerge, which are on the corner. And that's why they say by 2030s, this period from 2021 to 2030, this decade is going to be very, very harsh as far as the economy is concerned. Now look at the second scenario. Policymakers have not been able to prevent a debt crisis. Selfish interests, political ambitions, nationalism, all these factors combined, and nominal government rate debt in the advanced economies can be partially wiped out by unexpected inflation. If you remember, this is exactly what happened in 1970s. And the emerging market debt dominated in the foreign currency would not be annihilated. So the domestic currency debt you can remove, but the foreign currency cannot be annihilated. So many of the governments of the growing economies, not of the superpowers, would be helpless. And they need, what will happen? They'll default and they'll have to restructure their debts. At the same time, the private debts in advanced economies would become unsustainable. That happened, last time when the global financial crisis was there, when the banks failed. You remember that. And then this will spread to the safer government bonds. Even they might lose their sanctity. Today, we think they are the ideal ones. So, highly leveraged corporations and the reckless shadows would be followed by indebted households. And if the debts are not financed, the banks would suffer and undergo losses. What happened in Indian Yes Bank crisis can happen again. To be sure, real long-term borrowing cost would initially fall because as inflation rises unexpectedly, as central banks are still behind the C curve, then the borrowing cost would initially fall. But three factors would push the cost up in a few months' time. First, higher public and private debt will widen sovereign and private interest rate spreads. And that's a major, major problem. Secondly, rising inflation and deepening uncertainty will drive up the inflation risk premium. When the people see that the prices are rising, they start holding up. And then that shoots the price up further. You hold up again. Already, the grocery stores in North America, Canada, and India, they have started holding the food supplies. And their refrigerated cold rooms and the warehouses are overflowing vegetables and the fruits because they know that the price is going to rise still more in the next 2 months. So it's a hyperinflation coming up. And the third factor is a rising misery index. Now you'll be thinking that you have talked of the never heard of misery. Misery index is the sum of the inflation and the unemployment rate. And ultimately it becomes a Walker moment. You know, Walker moment happened in 80s. Paul Walker was the chair of the Federal Reserve in USA, and he increased rates to tackle the inflation. The result, double dip inflation in USA and debt crisis and a horrible economy for the Latin American countries. And now the global debt ratios are almost three times higher than that period. So any anti-inflation policy would lead to depression rather than severe recession. So this is a conundrum. If you do it, you are damned. If you don't do, you are damned. So under these conditions, central banks will be damned if they do, as I said, and damned if they don't do. And the governments will become semi-insolvent. Pakistan is already there. Bangladesh is on the verge. Countries like India, Israel would go by. But what about Myanmar? What about Togo, Tobago, Somalia, Uganda? Name it. At least 125 countries are going to have that. So the doom loop of the sovereigns and the banks in Eurozone, especially, and the global financial crisis will be repeated worldwide. And that will suck in households, private, yours and mine, corporations, and shadow banks. As matters stand today, this slow motion train looks to be unavoidable. This is a train track, let me tell you. A slowly moving train, but is going downward, downward to an abyss. And anytime it can wreck itself. The recent pivot from the Federal Reserve USA, ultra dovish to the most dovish changes nothing. The Federal has been in the debt trap at least since December 2018. You remember that stock and credit market crash forced it to reverse the policies for a full 1 year before COVID 19 came. With COVID 19 came, people have forgotten what was happening. And that break in the memory and the economic policies is adding fuel to the fire. So with inflation rising, stagflation shocks are looming. Now imagine European Central Bank, the Bank of Japan, the Bank of England. They have said already that they are preparing for the stagflation. The question is not when stagflation is coming, if whether it's coming or not. No, that's not the question. It is coming. When it's coming, that's a pertinent question. Are we prepared for it? That's a pertinent question. Are the politicians going to be innovative? Are the economists going to be able to suggest suitable measures? That's important. I don't know how many countries will wake up, how many finance ministers can visualize, but I shudder at the economic breakdown. That and the economic breakdown that is just around the corner. And the sooner we frame policy to oppose it, the better it would be. Think about it. Tomorrow may be too late. Thank you.